Then, on top of all of that, Putin invaded the Ukraine earlier this year. And whilst that didn't immediately have an impact here is that Indonesia has most of its food and energy needs here available locally or regionally. Hi, I'm Bruny, Head of Global Capital Markets for Lendable, and locally here in Indonesia, part of the Board of Directors of CFA Society of Indonesia. The world is more interconnected today at any point in the history of mankind. So the benefits of this has been that we've been able to enjoy foreign markets to sell our products, importation of cheap capital, but the downside is that we're also now exposed to forces outside of our control. The challenges at the moment are both caused domestically and imported from abroad. So domestically, we've had large FDI inflows leading to local wage growth as all these firms and startups and tech are all competing for the top talent in the market. This has then had a second order effect where local wages have increased as well in the bottom tiers of society as the minimum wages have had to be increased to keep up with the rest of the country. So basic goods inflation caused by food and energy shocks, both locally due to weather and imported due to rising fuel costs, have seen inflation rise from 2.18% in January up to 5.71% in October. Then, on top of all of that, Putin invaded the Ukraine earlier this year. And whilst that didn't immediately have an impact here in Indonesia, the second order effects of the inflation that caused. And if you think about it globally, a quarter of the world's grain was taken out of supply overnight, and a large chunk of the world's fuel supplies were taken out of circulation overnight as well. And so eventually that trickled its way down into Indonesia and helped assist with that inflation hike. On top of all this, US interest rates had been at historical lows for pretty much a decade. And then earlier this year, they started to increase. So if you're living in the US and you're taking a mortgage back in January, you could get a 30-year mortgage for around 3.1%. Now, if you go and apply for a mortgage, you can get that same mortgage at 6.3%. So you're talking about more than a double in the price of borrowing in the US. Then you compare that to what's happened here in Indonesia, where the real interest rates have only gone up from 4.5% for a local mortgage up to around 6% for a local mortgage here. So what that means is that international capital, which last year wanted to come into Indonesia because Indonesia was far more attractive because the rates of investment here were far higher, because the US markets have now caught up, Indonesian markets are now less attractive for that foreign capital. So this means that capital is now staying home and foreign capital from outside of the US is now heading towards the US. And so this is causing as well a weakening to the Indonesian rupiah and a strengthening of the US dollar. On top of all that, US interest rates, which had been historically low for more than a decade, allowing us to import lots of low-price capital into our country, these rates have more than doubled. So to give you an everyday example of US interest rates, if you're a mortgage holder back in January of this year, you could get a 30-year mortgage for around 3.1%. You'd be getting that same mortgage today in the US at 6.3%. That's more than doubling. Now, if you flip it to the other side, so instead of being a borrower, you're an investor. So if you're an investor in the US back in January, you're getting 3.1% to invest in that mortgage. But if you then flip it to today, as an investor, you're getting 6.3%. That's a much higher return. And so because that much higher return, you then want to keep your money in the US system as opposed to bringing it down to Indonesia, where back in January of this year, that same mortgage was 4.5%. That's a 50% top up to what the US mortgages were at the time. But today, Indonesian mortgages are around 6%. So they're pegging on par with actually US borrowing levels. And so if you're an investor in the US, you're more tempted now to keep your money at home as opposed to taking the extra risk to send it abroad. What this means is that the currency rate in the US is increasing, as well as that's causing a weakening of the rupiah. So it means that imported goods are more expensive now, which means that our inflation rate is also putting upwards pressure on that inflation rate as well. So we've got high inflation, high interest rates, and increasing unemployment. So we have stagflation. But it's not all bad news. The good news is that Indonesia has most of its food and energy needs here available locally or regionally. So we're not as impacted by the Ukraine war as, say, other parts of the world, such as Northern Africa or Europe. And even as such, those other parts of the world, whilst they faced a cyclical shock to their system earlier this year, they're all starting to respond. So an example is that earlier this month, US sanctions on Russia, on Russian fuel in particular, started to be imposed. So in practicality, the exports started to be cut off. Now, what we were expecting is a huge rise in the price of fuel. That actually didn't come through. And so the price of fuel is around $60 a barrel. This is nowhere near the much higher rates predicted earlier in the year. And so to top that all off, Indonesia's debt to GDP ratio is still only around 39%. So you compare that to others in the region, Malaysia is just under 70%, and the US is actually at 125% of GDP. Now, what this means in practicality is that if things go bad here locally, because the debt to GDP ratio is so low, that there's plenty of wriggle room for the government to take actions to actually stimulate the economy back into action. The last point around this is that Indonesia, because of the demographics and because of it's one of the more recent countries to be developing and to be modernizing, it's still in the nascent phases of consumer credit growth phase. And so that means that whilst there's some bumps in the road ahead, that there's plenty of upside to be had. Half the population here is under 30, half the population here are in that great phase of really building their wealth, building their assets up, saving money, and working and being really productive. And so what that means for the local economy is that whilst the world is looking at more weakness over the next 12 months, locally here there's some support, some structural support here in the system that should see it weather whatever's coming in the next 12 months better than other places in the world. So with all of these challenges facing the economy, plus that structural support that I was talking about in regards to the demographics and the stage of the consumer credit growth cycle that we're in, where should we be putting our money in the next 12 months? Well, with all the turmoil happening, now is actually a pretty good time to hold cash or liquid investments. There's a lot of investors in the world, and I've been to a few conferences lately where a lot of private investors are basically in a wait and see hold mode. And so let's wait and see. Let's see what's happening over the new year. Let's see what the new year brings. The northern hemisphere is in winter at the moment, and because of the Christmas season and New Year's season, a lot of things are shutting down for now anyway. And so people are putting their money into cash or defensive assets. But I think when things are uncertain and when you're in an environment like today where we're seeing a large structural change, we're seeing these challenges coming in, we're seeing the local structural support coming into play here as well, I think now is a good time to look past the price or return of an asset. The main thing to focus on is the actual asset underneath, fundamentally a good asset or a good company. Will that asset be worthwhile even if things are in a downturn? So for instance, if you're buying a speculative property on the outskirts of town where nobody else lives and there's no industry, maybe that's not such a good bet. If you're buying something in the middle of town where there's lots of industry, lots of local schools, lots of local infrastructure, maybe that will hold up better over time. On the flip side, if you're looking at companies, and if you're looking at companies that are producing products, what products are they producing? Are they producing an everyday staple that people are going to consume anyway, like mie goreng? Or are they producing something that people only buy when things are frothy, like jet skis or other luxury watches or this sort of thing? And so it's really about looking at the fundamental asset. Is it, if you're buying a stock, is it a really well-run company with low debt levels that's going to survive any crisis? If you're buying an asset such as a property or something like that, is it really fundamentally well located? Is it already constructed so it's not relying on a developer getting finance to construct it? I think overall now's the perfect time to be extra diligent when investing your money, because in an uncertain world we don't know exactly what's happening, and we never do know what's happening, but now more so than at any time in history. And but there's that old Warren Buffett saying, and he says, "Be fearful when everyone is greedy, and be greedy when everyone is fearful. And what that means is that actually there will also be opportunities to buy, and to buy underpriced things in the next 12 months if everything does downturn, like I mentioned. And so that's also part of the thinking about why people are holding their money in cash at the moment, just to wait and see what happens. But beware the asset that looks very attractive and it turns out to not be very attractive. So do your extra diligence and make sure that you're very confident in what you're investing. To top that all off, in a downturn, sometimes people can be unemployed, sometimes you can have financial stress, sometimes you can have more free time on your hand than you might normally have. It's often free and generally will always provide the most satisfying payouts, and that's the investment in yourself. And so if you invest in yourself when there's nothing else available, and even if you have no money, it's, there's online courses and this sort of stuff. You can look at CoinLearn as well. And so, you can always invest in yourself. That's often the best investment to make, especially if you're young. Anyway, I'm Bruny, and thanks for listening today. Good luck in 2023.